Today, the S&P reached new all-time highs, but is it as bullish as it seems? In this video, we'll talk about economic news and data releases that could affect the S&P, price action to look out for to help navigate it, and captivating stock trading signals with significant historical returns. Without further ado, let's jump right into the video. When looking at economic news and upcoming data releases, it could explain why the S&P broke down today, as many investors likely took some profits at the record highs in anticipation of some potential disruption in the markets. First, in prior videos, we've discussed how forward expectations of the federal funds rate could affect the market. After the Fed's last interest rate decision, S&P rallied due to a rate cut and Powell's slightly dovish language in his speech afterwards. However, they have mentioned that they would like to keep the rate unchanged momentarily to give them time to see the effects of the initial 3 cuts we saw in 2025. The vote was 9-3, with 2 dissents supporting no change and 1 pushing for a larger cut. And according to the last Fed minutes, a few of those who supported lowering the policy rate at the meeting indicated the decision was finally balanced, or that they could have supported keeping the target rate unchanged. Now, at the moment, Fed's own forecast expects 1 cut next year, while the market has priced in just under 1 rate cut by April and another one later in 2026. This is a huge discrepancy in expectation between investors and the Fed. And with that being said, as we move on closer to April, if that expectation from investors begins to dampen, it will certainly crunch down valuations, as interest rates staying higher for longer means it's more expensive for companies to borrow, hence less profitable. That certainly can happen if in later Fed minutes, language starts to hint towards no change longer than April. The next decision will occur on January 28, 2026, in which we will get more insights as to how the Fed is interpreting the data. Remember, a large factor in their decision to cut rates was the health of the labor market, as the unemployment rate has risen steadily since 2025. This makes it especially important to pay attention to initial jobless claims and the unemployment rate coming out this Thursday and Friday at 8:30 a.m. The median expectation is for the unemployment rate to drop 10 basis points to 4.5% from last quarter's print of 4.6%. Should it be higher than 4.5%, we are likely to see a sell-off in the S&P, as it could be a sign the economy is getting weaker. Ultimately, this would further strengthen investors' expectations of 2 interest rate cuts this year. However, given many investors likely already priced in 2 cuts, any change in expectation other than more than 2 cuts would have little bullish effect likely. Pair this with increased fears of the future health of the economy from the bad print, a sell-off could be strong. According to this article in MarketWatch, new hires in November totaled 5.12 million compared with 5.08 million separations, and U.S. job openings fell by 300,000 in November to the second lowest level since the tail end of COVID-19. When looking at these prints, it shows how weak the labor market has gotten since spring. Right now, the labor market seems to be treading water, as the economy is barely adding net new workers. With that being said, this is definitely a time to approach the market cautiously, as sentiment could turn back around for the worse if we start seeing further signs of weakening. Another thing to keep an eye out for these coming weeks is the Supreme Court's ruling on whether Trump's tariffs exceeded his authority in using the International Emergency Economic Powers Act of 1977 to justify his country-specific tariffs. The U.S. Supreme Court has indicated that it could release opinions on Friday around 10 a.m., meaning the decision could come this month instead of in June. A key factor in this will be whether the court's ruling will be a clean decision or if only some tariffs will be permitted. If certain tariffs are removed, this could cause bullish action in the relevant industry, as the balance between margin pressures and protecting consumers will be relieved. It was noted in this article on MarketWatch that the likelihood of the Supreme Court ruling in favor of Trump's tariffs dropped in the wake of oral arguments on November 5th over the matter. If they do not vote in his favor, he has other avenues to recreate the tariffs, which could also cause another wave of volatility and disruption when re-implemented. So keep an eye out for any major headlines around this, as it could quickly and vigorously impact the market. Now, taking a look at S&P's price action, we can see that it did in fact break the parallel channel that we've been talking about and went on to realize new all-time highs. In addition, in that process, we formed a bit of a triangle squeeze where you can see lows gradually getting higher and highs gradually getting lower. While breaks in these formations is generally a bullish sign, we have yet to confirm if it holds as support to confirm the pattern. In addition, with the recent profit taking and economic and political uncertainty, near-term bullish momentum may be difficult to achieve. If you are bullish, you want to see prices remain above our prior all-time high in November. Today, we closed just 2 cents below our all-time high in November, so not quite a break in my books. However, definitely something to keep an eye out, as if we start trading below that support line, we will go on to retest some of these lower levels of support that were once resistance. Now, if we do fail to hold, how far down could we go? For short-term price movement, if we draw a Fibonacci level on our most recent pivot, the 38.2 and 50% retracement levels can be helpful price points to use as a guide. If you've seen my prior videos, you've probably heard me mention if we break below the 50% retracement level currently at 6,895, there's a good chance we are retracing all the way back down to that low at 0% or 6,823. Notice that the 50% retracement level falls very closely in line with the top of our parallel channel. When you have a confluence of support levels, it makes that support stronger, so that could be a price level to keep in mind. Now, if I adjust this Fibonacci retracement to the start of our uptrend in November, it gives us some more macro levels to pay attention to. Should we break right back down below the top of our trend channel, the next target range is 67.96 by our 38.2 and 67.18 by the support on our pivot low in December. Lastly, if we take a look at RSI, we have yet to break and hold that resistance zone we discussed in last video. We want to see a break past this resistance zone and for RSI to remain above, as this will serve as a double confirmation of bullish momentum. Now, the first stock I want to talk about today is ticker SYK. They're a global medical technology company that makes surgical equipment, orthopedic implants, neurovascular products, surgical navigation systems, and other hospital-related medical devices. Their products are sold in over 75 countries and used by millions of patients annually. Stryker has consistently beaten earnings estimates across recent quarters, showing revenue and EPS strength versus expectations. They've had a strong revenue growth, often in double-digit numbers in recent quarters, but on the downside, they are sensitive to macro and healthcare-specific headwinds, such as tariffs and rising inflation on raw materials and supply chain disruptions. Now, here on the screen, I have a strategy I call trading range. This strategy identifies a rolling trading range, and when breakouts to the top of that range are likely. As you can see, whenever SYK's price in the white crosses above the orange line, a green dot is displayed on the price action signaling a trigger. We've had 7 crosses over the past 10 years in which the price rose on average 19.7% over the next 100 trading days. In all 7 circumstances, the price was higher, meaning we have yet to see this trigger fail to indicate a higher price 100 days out in the past 10 years. Now, we recently had 2 triggers on December 23rd and today, January 7th, in which the December 23rd trigger is currently up 3.27% as of today's close. When taking a look at the normalized reactions of the triggers, on the x-axis we have trading days out from the trigger, and on the y-axis cumulative performance across the time frame. In other words, what you are seeing here is what your returns would look like over the next 100 days if you were to buy SYK on each of the trigger dates. Each white line is one of the reactions, and the blue line shows the average return across all the triggers. In yellow, we can see the current active trigger on December 23rd, leading up to the 9th trading day. As you can see, we lead into the 100th day. The blue average reaches that 19.7%. In terms of drawdown risk, we saw prices drop as much as 12.6% from the trigger price. Taking a closer look at SYK's price action, I plotted out what that 19.7% return would look like relative to the trigger on December 23rd at a price of $354.82 a share. This brings us to an upward target of $424.92 a share and a downside risk of $331.85 a share, or a 6.5% stop loss to respect a 3-to-1 ratio. If you're not familiar, many investors like to structure their stop losses to a third of their expected gain. In this way, if you're right only a third of the time, you can be profitable. Now, if you take a look at bigger picture, we are trading within a rising triangle, in which notice at the bottom support marked pivotal points for the overarching trend, in which we recently bounced off on January 6th. This potentially implies a retest of its prior all-time highs as it works its way up to the resistance zone between $399 and $406 a share. Taking a look at more near-term levels, we've been trading within a falling wedge which broke upwards on the 7th off the bullish divergence it was experiencing. This implies a potential retest of prior swing highs around 372 to our resistance that's been developing since July of last year. Now, I don't think SYK is going to make this move immediately. Notice that we are also approaching our 200-day moving average, in which at times can be met with stern resistance. In addition, notice RSI is currently trading within a triangle pattern and currently at the top of our boundary. Some consolidation in the near future would not be unusual, if not a pullback, as it's been a long-standing resistance since June of 2025. In other words, patience is key here, as you may have an opportunity to get lower prices before further potential breaks occur. Now, the next stock I want to talk about is AMD, which is a major semiconductor company designing CPUs, GPUs, and AI accelerators for PCs, data centers, and high-performance computing. AMD has outperformed many peers in 2025, driven by strong AI and data center demand. This has been a key catalyst for AMD's growth, as they saw double-digit expansion in EPYC and Instinct GPU sales as cloud providers continue to expand infrastructure. In addition, yesterday, AMD revealed their new AI PC chip, enticing consumers with a new, more powerful chip to continue driving demand. Now, many of you know AI stocks took a bit of a hit due to overvaluation concerns and high R&D spending. However, in recent times, we've seen consolidations and strength gradually returning into the sector. If we can see continued growth in performance and strong innovation to justify the high spending in R&D, this could be a great continued catalyst for AMD. Now, here on the screen, I have a strategy that uses a normalized 90-day realized volatility to understand when reversals or stronger continuations of the trend are to occur. The premise behind the strategy is in high volatility moments, it is often associated with panic and hysteria, as stock markets tend to gradually climb and then steeply fall off at a much quicker rate. When this high volatility begins to squeeze down, it's often an indication of consolidation or tightening of price movements, and the next big move is ready to occur. So in the top panel, I have AMD's stock price over the past 10 years and that normalized volatility measurement in the bottom panel. Whenever the white line is above 80, indicating extremely high volatility environments, and it crosses below the red line, this is an indication that volatility is squeezing in, hence a potential reversal as consolidations take place. We've seen 9 triggers for AMD with the strategy over the past 10 years, in which on average the price rose roughly 35% over the next 99 trading days. When looking at the 99 trading day, 6 out of the 9 times the price was higher, or 67% of the time. The strategy has performed at a profit factor of 4.25, meaning your wins are roughly 4.25 times larger than your losses on average. If the strategy were to continue to perform at that profit factor, even if you were right only 19% of the time, you'd break even. We recently had a trigger on December 24th at a price of $215.04 a share, in which it's currently on trading day 8 and down about 3%. When looking at the reactions, we can see the average performance in blue and in the yellow the current active trigger. As you can see, it's currently performing very close in line with the average. Now here's where things get interesting for the strategy. Notice that on day 16, or roughly 2 weeks from now, the average begins to climb. In addition, notice in the first 20 trading days, many of the triggers are in the negative before going on to achieve returns upwards of 20%, some dropping as low as 15% initially before recovering. So based on historical reactions, we know over the next 8 trading days, further drawdowns are likely before any upside occurs, and ultimately it's not until after that point we start to see a majority of the triggers begin to perform well. So keep an eye out for AMD leading into the 3rd week of January, as from historical reactions we can see it certainly can move over the following next 80 trading days. Taking a closer look at price action, I mapped out what that 35% return would look like, bringing us to an upside target of $289.92 a share and a downside risk to $190.85 a share to respect the 3-to-1 ratio. Taking a look at the support and resistance levels, AMD is currently trading within 2 triangles. If you are a bull, you want to see a break upwards outside the triangle range and above our prior all-time high in March of 2024. We are currently testing the top of the support zone created by the 2 bottoms of the triangles. I drew these support lines relative to RSI, in which notice we have a confluence of support from 2 instances of bullish divergence, both bouncing off on December 17th. This led us to break our trend line in RSI that's been developing since October of last year. Generally, this is a bullish sign, and as you can see, we had a small increase in price during the break. When you break trend lines, you often go on to retest them as resistance, so maybe we go on to test the bottom of the support zone created by the triangles and down back to that RSI trend line before we see further momentum. Also notice we have a very large gap from October of last year that hasn't been filled. Whenever gaps occur, they often go on to fill them later on. So at some point, we likely see prices drop back down to that point, if not in the next 4 months. The top of that gap also marks an important support in line with our support zone from the triangles. If we see it break down below, chances are we go back to test 194 right by our stop loss level and even lower to fill the gap. Remember in the last slide, I noted that in many instances we saw drawdowns over the next 2 weeks from this point, upwards of 15% at times, before seeing a full recovery. I marked where a 15% drop would bring us, which is around $183 a share, just in line with our swing high back in August of 2025. So based on history, it wouldn't be abnormal to see a drop down to that point and have a strong recovery afterwards. The theme we are seeing here again is patience is key. From history, we know that over the next 2 weeks, we have a potential window to get favorable prices before a likely move upwards. Ideally, a practical smart play is to wait and see how we react to that support zone created by the two triangles before making any further decisions. The last stock I want to talk about today is Moderna, which is a U.S. biotech firm focused on mRNA-based therapeutics and vaccines, such as their widely used COVID-19 vaccine. They are also advancing mRNA drugs in oncology, seasonal flu, rare diseases, and other infectious diseases. Now, if you were familiar with the stock market during 2020, you likely remember the humongous boom in stock price Moderna experienced as the COVID-19 vaccine was released. Well, quite frankly, ever since, they have been on a long decline for almost 4 years. However, we may have a bullish catalyst that will send mRNA back up to higher levels. Recently, Moderna filed for marketing authorization of its mRNA 1010 seasonal influenza vaccine in the US, EU, Canada, and Australia, a major pipeline milestone expanding its respiratory vaccine portfolio beyond COVID-19. In other words, this could reinvigorate forward performance expectations and valuations as they pretty much have been dwindling due to fall off in demand for COVID vaccines. For stocks like Moderna and many other biotech companies, its value isn't derived based on current financials, but rather future growth expectations showing long-term potential, along with ability to manage high R&D costs with sufficient cash runway, also referred to as their cash burn rate. A staggering drop like what mRNA experienced calls for a reassessment on fair value, as it's likely very cheap relative to forward ratio metrics. And with a new catalyst to revamp growth expectations, this can make for a great bull case for Moderna, as it will boost their cash flows and improve their cash burn rate. Now here on the screen I have a strategy called Trender. Trender uses a measurement of volatility called ATR to project typical levels of movement within a range. When price breaches up outside this range, it signifies that the market environment has shifted, usually due to a positive catalyst that has caused price to increase outside of typical volatility levels. These crosses are usually an indication of further bullish momentum and a shift in trend. We've had 4 realized triggers over the past 10 years, in which Moderna rose 81.5% on average over the next 98 trading days. 3 out of the 4 times, or 75% of the time, the price was higher on the 98th day. The strategy is performed at a profit factor of roughly 4, meaning your wins are 4 times larger than your losses on average, meaning if it were to continue to perform at that rate, you would only need to be right 20% of the time to break even. We recently had a 5th trigger on December 26 at a price of $34.86 a share. It's currently on the 10th trading day and up 3%. And when looking at the reactions, we can see the average performance in blue lead up to that 81.5% on the 98th day. Notice that average performance truly begins to pick up on the 16th day, or roughly a week from now. This is not a guarantee that it will perform in line with the average, but rather to provide guidelines on what was considered normal based off of previous reactions. Taking a closer look at Moderna's price action, I plotted out what that 81.5 return would look like to bring us up to $63.32 a share, with a downside risk to $25.44 a share to respect the 3-to-1 ratio. Notice we have been trading along a major trend channel since 2022, in which we have started trading it back above the bottom range. Taking a closer look, we bounced off support drawn from our RSI support, in which in that process we also experienced some bullish divergence as indicated by the pink trend lines. From this point, we want to see MRNA break the top of its consolidation base at $35.95 a share and sustain above. This would be a great bullish sign. We are breaking out of the temporary trading range and moving on to higher prices. Now, bear in mind we are at a critical resistance currently, and RSI is just barely reading overbought, meaning some consolidation, if not a pullback, is likely before a further move upwards. Maybe we see a pullback to retest its 200-day MA as support or trade sideways before a break occurs. Realistically, the most practical approach would be to wait for a break past $35.95 outside our consolidation base that's developed since the start of 2025, or at the retest at that 200-day MA. And that is all for today. Thank you so much for watching my video. Please give it a like and subscribe if you'd like to see more, and I'll see you in the next video.